Hello everyone and welcome back to That Investing channel. The market is looking quite expensive to the point of bubble territory right now, with the S&P 500 up close to 26% over the past year and the Nasdaq up 29% in the same time frame. Valuations are becoming quite stretched on this AI wave that we are seeing in the market, and I have a portfolio of over £50,000 held on Trading 212 where I invest in individual stocks. These ones tend to be monopolistic or have a competitive advantage with years of predictable free cash flow growth. But what am I doing in this high market valuations that we are seeing right now? Am I hoarding cash? Well, I'm going to be answering that question today, as well as a deep dive into the highest weighted companies in the market and the S&P 500 and whether they're actually overvalued according to profitability ratios and DCF models. And as always, if you get something out of this video, then please consider maybe giving it a like and subscribing to the channel to not miss out on anything. So let's kick it off with the progress of the S&P 500 and why I think we are sort of entering bubble territory. I see that with this market being up this much and quite a bit in 2023, that doesn't necessarily on its own mean that things are overvalued. It just means that maybe we should take a look at it. And in that particular case, I think the fundamentals of businesses are getting outpaced by their share prices and what is being priced in to the growth of individual companies. So I'm going to be talking about that today, but I do believe that this AI story and the build out of AI has lots of people very excited. And I'm seeing lots of euphoria in the market right now. People are buying up Palantir at 60 times sales and above, and sorts of Costco at over 60 PE. So I'm seeing lots of stuff, the likes of which is a bit concerning for me. Additionally to that, we have stuff like passive index investing, which is becoming more popular, with record highs of both index investors and retail investors putting money into the market. As you can see by this particular article, it's on Morningstar, for example, telling us that the growing popularity in index fund investing from Europe is at an all-time high, growing by 13.41 billion euros, gaining market share over other forms of investment, particularly active funds. In fact, this and other retail investors have now pushed the market to a price to earnings that is sitting around 29 to 30 times, which is a hell of a lot higher than the averages in the past 10, 20 or even 30 years. So if we take this further, I'm going to look at the top 10 stocks in the S&P 500. Now, I've had to take a few out because they can't really be valued and priced to the same ratios that the other companies are. The likes of Berkshire Hathaway and JP Morgan, how they operate doesn't really lend itself to price to free cash flow as a good metric to value these companies, or a price to earnings. So I removed them and put the next highest weighting companies, Visa and the like, in this one. Now, looking at individual metrics, we have only two companies that have a PE below the average of the market right now, and that is Google and Meta, sitting at a mid to high 20s, which isn't that far off the average on its own. And then all the rest are sitting quite high on the PE front, with Tesla and Broadcom being well over 100 times, which I think is just a massive valuation and a lot to be priced into individual companies. And I would say, look at this metric, it also lends itself towards the market being overvalued, with most sitting above the current market PE. Now, all of these stocks, these companies that have high PEs, make up a market sort of weighting of 38%. So these 10 companies account for over 38% of the S&P 500. So that's 500 companies, but over this, 38% of these 10 actually weigh towards it. And I just think that means that it's not really as diversified as it once was, the S&P 500. So you've got to look at these individual companies and how they're being priced, because it will have a massive impact if any of these individual companies suddenly go massively down because they're overvalued. And then we consider their price to free cash flow. We can see a similar trend to the PE. If we go for around a market average of 30, which is still quite a bit higher than the average I would have said, although I couldn't find a particular metrics for that, The price to free cash flow, as we can see, we only have one stock that's below that, with that being Meta again, which is actually not looking too bad. And then we've got Tesla at the highest at over 300, which is just insane, and Nvidia and Broadcom both sitting in the high 50s. Again, this metric could signal overvaluation from looking at it as a whole, when we're just looking at a free cash flow standpoint, obviously. Now, there is complications with free cash flow right now, with lots of these being big players in build out for AI, and their capital expenditure is going to reflect that and then take away from their free cash flow. So certain companies like Google are going to look good on their price to earnings, but going to look bad on their free cash flow because of capital expenditure around AI. But even then, it does not look great on the ratios for these top companies, which actually make up a big weighting in the S&P. Now we get onto historical averages, and I interpret what I'm seeing on individual companies based off these sorts of charts. Now, we're still going to focus on their profitability, so price to free cash flow, operating cash flow, and price to earnings, because I think they're one of the most important metrics for individual companies. Now, Apple sit at a 10-year high for all three metrics, and I would say this is definitely signalling me overvaluation, or just at least that the fundamentals are remaining flat or not growing quick enough to match the share price's massive increases this year. So when I see this, if I was an Apple investor, I would be a little bit concerned personally, because I'm seeing a margin expansion on their metrics, but not really seeing the fundamentals grow with the share price. And that counts for a weighting of over 7% in this index. Now, Tesla and Broadcom sit at exceedingly higher price to free cash flows also. They're an all-time high for these companies in the past 10 years, even when you consider the fact that they already trade at exceedingly high valuations anyway. Now, the same is true for Google at a 10-year high. However, it can be argued with a low price to earnings ratio that this is solely because of capital expenditure surrounding AI, so we might be able to explain that as maybe being temporary over the next couple of years. Either way, looking at all of this, there is very little undervaluation here in any of the historical metrics. In fact, Amazon is the only one in the past 10 years that is below his historical averages. Now, it can be argued that this already trades at quite high ratios anyway, but their price to operating cash flow is exceedingly low compared to their market average right now. So I do think that's a positive for Amazon, but not really for the others maybe. And then on the whole, I see overvaluation from all of these 10 stocks on these metrics and on this historical averages. We've got one stock that has no free cash flow right now, Eli Lilly, even though it has in the past. We have 4 sitting at 10-year highs of a price to free cash flow, and 3 sitting at averages according to historical metrics, with only 1 in the form of Amazon signalling maybe undervaluation on those 10-year averages. Now we consider the growth rates and what is being priced into each company. Now, this is largely up to my own assessment, so feel free to disagree, of what is acceptable ratios for these companies to trade at in the future. But I carried out a discounted cash flow analysis for each of these companies and then found the growth rate for free cash flow that they're likely to deliver for the market average over the next 9 to 10% CAGR over the next 5 years. So what sort of growth rate are we expecting with the current share price? Now, all of these stocks, I would say, expect growth rates over 10%, with Meta only expecting 11% at its current share price, which I thought was pretty good. Now, compare that to Tesla and Broadcom. That's where we have a few issues. There's factors that are factoring in over 30% free cash flow growth each year for the next 5 years, which I just find highly optimistic for both companies. Now, that obviously is up to lots of interpretation about the ratios they should be trading at, and I tried to use 5-year averages of ratios where I thought they were applicable. But these companies trade at very high valuations, and I'm not too sure that this is maybe the best way to value them. All these growth rates look fairly high to me, broadly speaking, and I always prefer to be conservative in my assessment of estimating free cash flow because nothing is certain. And we are talking about a growth rate each year for the next 5 years, which is far from certain and lots of things can happen. But all told, looking at this breakdown of all these companies and all their metrics and price to earnings and profitability and historical references, I do think we are in a fairly pricey sort of level with these companies that make up about 38% of the S&P 500. And I see lots of this optimistic and sometimes speculative pricing being put into these companies at buying at these sorts of share prices. So if you ask me, we're heading towards dangerous territory to be buying into companies that are priced quite high levels of growth on already high sort of price ratios. So I just see that as being a double sort of problem. Personally, I'm starting to build up my cash position, not because I'm trying to time the market, because I literally am still buying into Brookfield when it dipped below $55 per share last week, where I see undervaluation. I'm not trying to time the market, but I do see that just there's very few opportunities that I want to buy into right now. These businesses that I all bought at, they're all 10% or above their share prices than when I bought them. So in this current climate, personally, I could see there being a correction in the next 6 to 12 months. There's nothing certain. I can't say why that is. There's lots of financial metrics out there that may indicate towards that, bond yields going up and stuff like that. But to me, just from looking at the valuations, I don't think it's sustainable. And I don't think that people are going to continue to buy in at these levels if there is suddenly some bad news. And there's always possibly going to be some bad news round the corner. But thanks for watching, guys. I do appreciate it. And I'll catch you in the next one.